Tax planning is most important before the year ends. Right now, we are in this fourth quarter of the year, and now is when you want to do your tax planning. So if you are looking at your taxes, and normally you would be up in this 32% tax bracket, and you were wishing you were down in the 24% tax bracket, well, the control and your ability to do that happens now before the year end. So how do you do that? First thing you need to do is start gathering as much information you have. Very importantly, you want to look at your estimated payments or your withholdings in your paycheck. Most people in April who are surprised in having to pay taxes are surprised because they have come to April and are just running their tax return and have found that they have not withheld enough out of their paychecks, or they have not made enough estimated payments. So the first thing you can do to control is to run a projection of this year's taxes and find out, have you withheld enough? If not, I'd rather know now in the end of the year and not at the last minute in April. At the minimum, you're gonna have time to prepare to pay that. But even better, you can actually control what your taxes are and maybe look at making some reductions. One of your main controllables is just your employer pension plans or your 401k plans. Have you maxed it out for the year? If you haven't and you're looking at your tax bill and it's higher than you would like it to be, you can actually lower your tax bill by simply funding your 401k or your 403b or whatever your employer plan is. Your next step in controllability is understanding your investments. Some of your investments are paying interest, simple interest. That's fully taxable. Some of them are paying dividends. Are they short-term, long-term qualified on the dividends and the capital gains? Have you taken any capital gains, any capital losses? How has that all come together for the year, and what controllable items do you still have? When you start looking at capital gain strategies, capital gains are taxed different than ordinary income. So if your taxable income is between 0 and 80,000, any capital gains, any long-term capital gains are actually taxed at 0. Wow, maybe this is a year where income's lower and your taxable income, married filing jointly, is below $80,000. Well, let me take a look at my investments. Maybe I want to realize some capital gains. Maybe I want to sell something and sell it and pay 0 tax federally. You might be between 80,000 and 500,000 and you want to free up cash and you have a plan knowing that the long-term capital gains are 15%. At least you can bake that into your tax planning and know what you're going to have to pay to free up that capital. Maybe you're in a big year, married filing jointly, taxable income's over $500,000, and you realize that capital gains, even long-term capital gains, are still at 20%. Beyond that, there is a net investment income tax that could be another 3.8% on top of that. So this could be a year where you actually want to take a loss, right? Drive your income taxes down. Looking through your investment, anything that's not in a retirement account that you want to realize a loss on that has a loss. You can look at tax gain harvesting. Tax gain harvesting is realizing those gains in the lower tax years. Final talking point I have here are qualified charitable distributions. This is one of the points of charity that you can do. There are many charitable actions you can do that will reduce your taxes. But this is really impactful for anybody that is in those required minimum distribution years. Required minimum distribution is at age 72. Now, number one, you do want to make sure that you are taking your required minimum distribution, and that's done before the year ends. You can take that money that would be a required distribution directly out of your IRA, and you can give it direct to charity. You can give up to $100,000. And the best part of this, those monies don't even hit your tax return. It's money that comes out of your IRA. It would normally be taxable, but since you have given it directly to charity, it doesn't hit your tax return at all. These are only a few of the items on the checklist. There's actually quite a few more controllables. But if you are concerned about your taxes, you want to look through and see what your controllables are, and you want a free tax reduction analysis here at Pure Financial, we are glad to run through that analysis and see how many of these items may apply to you in your situation.